Hello. Before we get started with content, let me go over a couple of things regarding how this is going to work. So first of all, I'm going to be working with, through this entire review, all the parts of this review, the concepts, definitions, and formulas chapter handouts that are included for you in the additional materials section of each chapter. And the other thing that you need to know is that on the video, you're going to see that these are labeled handouts, and your version is labeled chapter. So don't worry about that. I just changed the name from handout to chapter. All of the material except for this one little change here on the title page of each chapter's key concepts, definitions, and formulas is exactly the same. Let's jump right in. So what I'd like to do is go over the key concepts, definitions, and formulas for everything that we've covered so far. So we started in the first class learning about bonds. Bonds are fixed income contracts. So if this were a bond issuer here, they'd get a bunch of money in return for contractually promising to make these payments. These are called interest payments for a certain amount of time. And then typically at the end of the contract, the initial amount of money that was borrowed is also paid back. And when we draw up visually a contract like that, we call this a cash flow diagram. Okay, and as we know, bonds are transferable contracts, so the lender has to provide these cash flows to whoever is holding the bond, and it doesn't matter what the bond might be trading for, what price it might be trading at in the marketplace. The issuer of the bond just has to follow the contract no matter what. Okay. So we have looked several times at the Great Recession, and we will continue to throughout the term. So good to know the key points. March of 2009 was about the nadir of the Great Depression, although of course we didn't know it at the time. In 2008, the S&P stock market, the stock market represented by the S&P 500 fell about 40%, and then another 20% through the middle of March. And there were all kinds of crazy things being said at that time by very smart people like Paul Krugman, etc. Okay, and we looked at this bond example for HCP without knowing much of anything, but it did kind of give us a framework that's good to think about through the semester, starting with a qualitative analysis and then using some of our accounting knowledge. Particularly, we're going to be drawing all semester on balance sheets, income statements, and cash flow statements. In this case, we looked at the balance sheet, which showed that this particular entity, HCP, had many, many more current assets than current liabilities. That gave us warm, fuzzy feelings because the bond contract we were thinking of buying ended in 6 months. So we didn't care too much about other stuff on the balance sheet in the distant future. And then in this example, the other thing that we checked was a set of cash flow statements for HCP, and we looked at the 4 most recently reported quarters, and we remembered that, of course, for cash flow statements and income statements, unlike balance sheets, these are flows of cash, so they are additive in time. We saw things like that. And net, if we considered all the cash flows for the company, this company is generating a lot of cash. So about 2.5 months ago, it was in a very good position to meet the debt contract, and also again during the past year, as of about 2.5 months ago, the company was generating a lot of cash, not burning cash, so prospect look pretty good. Okay, and so we went ahead and bought that bond, and we did pretty well with that. With the key point, very little risk. We're going to keep coming back to risk all semester. Okay, so the key aspects of finance, you need to know what it is, okay, and what it studies, okay, financial instruments and related derivatives. We looked at those in some depth. We identified 3 branches of finance, and we pointed out that businesses in this country to survive must do only 2 things, right? Okay, so make more cash than you spend and follow applicable laws. And of course, we talked about you could choose to do much more than that. And we looked at some current examples about how the Business Roundtable is changing what they feel is important for any business in this country, from just doing these two things and maximizing shareholder value to doing these two things and maximizing stakeholder value, which is quite a profound change. Okay, all right, on to handout number two, capital markets and instruments. So we defined capital. So that's our cash raised by entities for big projects, right? Not for day-to-day operations. And source of capital is just anywhere or anyone you can go to get cash for your big projects. And so there are two types of capital sources, okay? There, and we will return to these all semester. We've returned to these virtually in every chapter, right? So debt capital is some contractual type of thing where you're taking out a loan or you're issuing a bond, in either case, contract specifying the cash flows that you have to issue in the future for getting a bunch of cash now. And equity sources, issuing shares of stock, that's increasing the size of the ownership club of our entity. And also we consider as an entity source retained earnings, which is net income minus dividends. So that's money that the firm has generated from operations and that it has not chosen to give back to its owners as dividends. So those are all our sources of capital. Capitalization is our description of the forms of capital an entity has used. And we looked at two ways to think about this. This is the gap way, okay, where the things in blue, again, represent capitalization. Debt liabilities and equity. Debt liabilities are only our interest-bearing liabilities, okay? A bunch of people have been confused by that, okay? So that does not include things like accounts payable. That's your operating day-to-day liability, okay? And the difference between these two, which we've come back to several times during the semester, is that we can measure these things based on GAAP accounting, or we can measure them based on market value. And particularly, there's a big difference between equity GAAP and equity market value. Liabilities pretty much GAAP, they're very close to market value. The big difference is between equity GAAP and equity market value. And we say in either case, a firm is capitalized by its debt and its equity. And financial markets, we got into any marketplace where firms or individuals go to raise cash on the one hand, and also any marketplace where financial securities can be traded. So what are financial securities? Stocks, bonds, loans, all that stuff. Okay, and then we looked a little bit at typology. Financial markets are broken down into long-term and short-term. Short-term are typically called money markets, and there are whole classes on money markets. We're not going to worry about that. We're much more interested in intro to financing long-term markets where companies go to get funds for big long-term projects like launching a new product line, building a new factory, buying another company that they think will help them in the future, that type of thing. And it's also where long-term securities are traded. Okay. So as we say, we're focused on long-term financial markets, and there are two types of those. Primary markets, that's where you go to issue stock or get a loan or issue bonds. And secondary markets are where stocks and bonds are traded among all of us mere mortals. And also the issuing company can get involved by buying back their stock. That would be a secondary market transaction, or buying back their bonds. Okay, and capital markets are a subset of long-term financial markets. Capital markets are restricted to marketable securities. Okay, so we could go to a long-term financial market and get a big loan, and it might say in the loan contract that this contract can't be transferred to anyone. That would not be illegal. We would not be thrown in jail for that. But in a capital market, we would need to have a bond, or we would have a loan that could be bought and sold by others, or stock. And typically, this happens on exchanges. We talked about a bunch of exchanges: New York Stock Exchange, NASDAQ. We looked at some bond exchanges, things like that. Okay, so equity capital, you get equity capital by how? Selling shares of stock, right? And we talked about the implications of that. And again, the key point is that shares of stock are not contract. Shareholders are promised nothing except the implicit guarantee that the management of the company will not be fraudulent. And stockholders, in the case of bankruptcy, are usually totally screwed. Why? Because debt has these contracts where it says in the contract, if the company runs into trouble, the debt folks get paid with whatever is left of the company first. And if you're in bad enough shape that you go bankrupt, the debt holders don't get paid 100% of what they're owed, and so there's absolutely zero left for the shareholders. Okay. And debt capital is get debt capital by taking out loans or selling bonds, like we said, in a primary market. Always contract, okay? Always, almost always, structured so that if the company can't make its contractual payments, the lender has the right to take over the company. And the only defense a borrower has against that is you can run to a judge and ask for Chapter 11 bankruptcy protection. That really just postpones the inevitable. Your lenders are going to wind up owning the company. The judge is just going to make sure it happens fairly, and hopefully all the workers don't get fired and things like that. So we know the two types of debt, loans and bonds. We'll be dealing with them throughout the term. Okay, and then we went into derivative securities and shorting. So a derivative is always a contract, and its value is always linked to the performance of some other security, asset, or index called the underlying. And derivatives are used for three things. We saw how options are used for insurance, and we saw how futures were used for hedging. We looked at an oil company that was doing that. And these guys are both options and futures are used by speculators who are guesstimating what's going to happen in the future and using these things to make a lot of money if their wish comes true and not lose too much otherwise. And so we looked at option contracts. Definitely need to know about option contracts for exam one. Okay, there are calls and puts. A call option is going to give us the right, but not the obligation to buy a security like a share of stock or something like that at a certain price at a certain time in the future. And a put option is similar, but it gives us the right to sell a share of stock or something like that in the future at a certain time for a certain price. So you can buy or sell, a call or put, so you have four possibilities. We pretty much focused only on calls because I don't want to drive you guys crazy and let it get too complicated. So you definitely should be comfortable with the option contract examples that we did in class. We did in-class quizzes, and you had for homework. Futures and forward contracts are used very much for hedging. If you are seeing something like the price of the oil you have to buy fluctuate around, going up and down, you might just say, I'm going to get a futures contract to buy it at $35 a barrel, even though I know it might be $25 a barrel when I need it. 3 months from now, it also might be $80 a barrel. So I'm just going to get a futures contract so I have certainty about the price I'm going to pay. I may win, I may lose, but I have certainty, and that makes it easier for me to plan for my business. And we talked about shorting. You definitely need to understand shorting of stocks in particular. Again, we did examples in class, in the homework. I think we had an in class on that one too. Basic idea is you borrow an asset, say a share of stock in our case, that you don't own, okay, and you sell it, and you're hoping that the price is going to go down so you can buy it back in the marketplace, return it to its rightful owner, and enjoy a profit from that. Okay, so that's chapter 3. Chapter 3 is our review of accounting, And I hope you have seen by now that, as Warren Buffett says, accounting is the language of finance, particularly financial accounting. And we're going to use it all semester. So if you've just been thinking, oh, this is going to go away, I'll fake it through these couple homeworks, that is so wrong. And you really need to understand your financial accounting. If you don't now, just start working on it. It's probably too late for exam one, but start working on it immediately following exam one, or I can guarantee you're going to be very, very unhappy in this course, and frankly, it'll be hard for you to pass. Okay, so let's see here. We looked at a couple of examples. In finance, there were two particular things I wanted to illustrate for you. One is we use journal entries to see what's going on if something big happens without having to make a whole new set of financial statements. And to do that, we looked at our leverage buyout example, and that's where we have an entity wanting to reduce its number of owners. So it uses its money, the entity's money, to buy shares from some of the owners. It takes those shares, puts them in a burn barrel, and burns them effectively. So when the firm does this, this is called a share buyback. And we looked at a case where the firm, we're looking at West End Advisors, did this with a loan. It actually literally went to JP Morgan Chase and got a loan and used the proceeds to buy the shares back from one of the owners. Okay, and so we saw the journal entries for this. You take out the loan, you get the cash, but now you have a new liability, and then you buy back some of the owner's shares, and that's of course paid in capital. You live by the paid in capital, you die by the paid in capital, and paid in capital is part of equity, right? Okay, and then the cash goes out the door to pay that owner to get their shares. So the net effect here is that the equity goes down, and the debt goes up. Okay, so that's a debt for equity swap, this time financed as a leverage buyout. So we do that type of thing, use journal entries to suss out what's going on. The voluntary Chapter 5 on Fannie Mae gave another great example of how you can understand a lot of complicated stuff just by doing something like this without doing whole new financial statements. So here are the implications, and this clearly has made the firm more risky, right? Because now it has this additional debt liability where it's got to pay interest, and it's going to have to pay that back someday. When all this was in equity, what do you have to do with equity? Nothing, right? No promises. You just got to be not fraudulent. Okay, so it made the firm riskier. Okay, and then the other thing that we're going to be doing, we've already started doing, but we'll be using this with a lot of our models throughout the semester, is we're just going to use net PPE instead of PPE and accumulated depreciation. So it's a lot simpler, and it's very much like, for those of you who have seen it, the way that amortization of a patent works, for example. Okay, so the old GAAP method on a balance sheet, you'd see total PPE at cost here minus accumulated depreciation equals book value, and that book value is net PPE. Okay, and all we're going to do is just work directly with net PPE and not worry about these other two things. So it's definitely simpler. Okay, so what is net PPE? Net PPE is always just PPE minus accumulated depreciation. It's the PPE we've got minus the amount of wear that it has incurred, and it's a much simpler way to track things. So if we're tracking things in our company with net PPE, okay, when we buy it, we just say DR net PPE and cash flies out the door if we're paying for it in cash. And let's say it has 5-year life. So say 5-year life. Okay, and so at the end of 1 year, here you see this is, we're starting at XO, we go to X1, that's 1 year later. So we have to reduce the value of this by 20% because it's worn out by 20%. So our very simple way to do that is just depreciation expense. Whenever you have depreciation, it's always depreciation expense, and we just say CR net PPE. So very simple, very straightforward. So now on the balance sheet, all we show at the end of the year, we have one line instead of three lines. And you see the bottom line from the old accounting way is the same number, but you've got these two other things to deal with. We're just keeping it simple and having the one line. Okay, so those were the two specific things we went over, but as you know, you need to know financial accounting. As Warren Buffett says, financial accounting is the language of finance, and I hope you've seen so far that that's the truth, the whole truth, and nothing but the truth. Okay, so then handout 4 is we had 2 chapters on, well, really 3 chapters on finance applications of accounting. Handout 4 was the first one, and that's where we learned the balance sheet valuation method. Okay, and to get there, we had to understand that there are 3 measures of equity for an entity. And we've come back to this several times, so you really need to know this. So the gap measure just comes from the fundamental accounting equation, which says asset equals liabilities plus equity at all times under all circumstances. So through the magic of algebra, we can solve that for equity. So equity gap or equity accrual is equal to assets or at cost or cost minus square minus liabilities. Okay, second value of equity. So we have our 1 here. We have our 2 is what Warren Buffett would say Mr. Market is thinking that the value of this firm is to all its owners, all its shareholders. And that is always nothing more than the number of shares of stock outstanding times the price per share. Okay, and that's sort of a wisdom of crowds estimate. On average, everyone who's active in this company, owning a piece of this company, that's the weighted average view of everybody. Okay, and if we could buy all the shares of stock, we'd own 100% of the firm. Okay, and intrinsic value of the firm is simply our best estimate of what the firm is worth. Maybe we think Mr. Market is wrong, okay? And we're going to come up with our own estimate, and that's going to help us make an investing decision, okay? And in this chapter, we did this, I'll say, in this chapter, we do this using the market prices of assets and gap values for liabilities because that's the balance sheet valuation method. Okay, we're going to find other ways to get intrinsic value estimates of a firm's worth as we progress through the term. And then in general, this will always be true. We, as an erstwhile investor, we compare our estimate of intrinsic value or true value. We've also called this equity true. It's our sort of shorthand for intrinsic value. We compare that to Mr. Market's value, and if our estimate of intrinsic value is way much higher than Mr. Market's, we might want to buy some or all of this company and go from there. All right, so in particular, our method for getting an intrinsic value, comparing it to Mr. Market, in this chapter is the balance sheet valuation method, okay? And the steps for that, we've done this in class with two examples. You've had this for homework, and we also, I think, had an in-class quiz on this. So first of all, find that intrinsic value and start with our GAAP balance sheet. Okay, so right, start with that. And the problem that we have with that is that it's showing its assets at cost or cost minus where, okay? And so we want to do 2 things. We want to replace the cost or cost minus where of the assets with market values, and those we have to go out and estimate, right? For HCP, their big assets are their buildings, right? They rent out space in their buildings to make money. So we would have to estimate the market value of each one of its hospitals, of its medical office buildings, all that stuff. And then also we have to recognize that GAAP just completely ignores some assets. And for you, my marketing majors out there, you know what I'm talking about. I hope you have heard in your marketing courses about the extraordinary value of brands, and I hope your profs have complain to you how those are not recognized by GAAP accounting, and they probably should be. So, for example, the value of the Apple logo, clearly worth at least $1 billion or two, and it's nowhere on Apple's financial statements. And we did look at the example of Lenovo buying the ThinkPad business from IBM. So Lenovo does have that represented on their balance sheet, hidden in goodwill, because they paid a ton of money for the ThinkPad brand. They still use the ThinkPad brand, and it's their premier brand over at Lenovo. Big Lenovo fan myself. Okay, so once we've done that, we've morphed our assets from this sort of crummy thing to estimate a company's worth into something much better, and that allows us to say our estimate of intrinsic value is equal to the assets at market value minus the liabilities, right? So equity true is our estimate of intrinsic value. Okay, so that's that. All right, what else we got going here? After we do that, we ask the eternal question, what does Mr. Market think of this thing? Well, Mr. Market always thinks that the value of the firm is the share price times the number of shares outstanding. So now we have our intrinsic value estimate, our best estimate, our equity true for the firm. We know what Mr. Market's view is, and we can now make an investment decision. Okay, so we can say, for example, if Mr. Market's view on what this entity is worth is way much less than we think, then maybe we want to go ahead and buy. Conversely, what if Mr. Market's view was way much higher than we thought the intrinsic value was? We could take a short position, right? We could short the stock and try to make money that way. We could also use puts, but again, I'm not holding you responsible for put options.